Welcome back to Wealth and Wisdom. In the last video, we talked about how to evaluate individual stocks, but today we're going to shift gears. Instead of focusing on single investments, we're going to discuss how to build a diversified portfolio. Diversification is one of the key principles of investing, and it's vital to help you manage risk while maximizing potential returns. So, let's get started. First, let's define what we mean by diversification. Simply put, diversification is the practice of spreading your investments across different asset classes, sectors, and geographical regions. The idea is that by having a variety of investments in your portfolio, you reduce the overall risk. For example, if you only invested in tech stocks and the tech sector took a hit, your entire portfolio would suffer. But if you also had investments in bonds, real estate, and international stocks, these other investments could help offset the losses from your tech holdings. The goal of diversification is to minimize the chances of any one investment dragging down your entire portfolio, ensuring that you can weather different market conditions. So how do you build a diversified portfolio? Let's start with the core asset classes you should consider. A well-balanced portfolio typically includes a combination of stocks. Equities are the foundation of most portfolios because they have the potential for higher returns over the long term. But stocks also come with more volatility, so they should be balanced with other asset classes to manage risk. Bonds. Bonds are more stable than stocks and act as a counterbalance in a portfolio. When the stock market is down, bonds tend to hold their value or even rise. They're great for providing regular income through interest payments. Investing in real estate, whether through direct property ownership or real estate investment trusts, also known as REITs, can give your portfolio exposure to a different asset class. Real estate often has low correlation with stocks, meaning it can perform well when the stock market is down. This includes things like gold, silver, oil, and agricultural products. Commodities can act as a hedge against inflation and add a level of protection during market downturns. Keeping a portion of your portfolio in cash, or in cash equivalent assets like money market funds, provides liquidity. It also gives you the flexibility to take advantage of opportunities when they arise without having to sell other investments at a loss. Next, we're going to talk about how to diversify within the stock portion of your portfolio. One of the most important ways to do this is by investing in different sectors and industries. The stock market is made up of various sectors like technology, healthcare, financials, energy, consumer goods, and utilities. Each sector reacts differently to economic conditions, so when you spread your investments across sectors, you can help smooth out the volatility. For example, when the technology sector is booming, the utility sector might be more stable or provide consistent dividends. Investing in ETFs or exchange-traded funds or mutual funds that focus on different sectors can be an easy way to gain broad exposure without having to pick individual stocks. Another essential type of diversification is geographic diversification. The global economy is interconnected, but different regions perform differently depending on factors like interest rates, politics, and economic conditions. Investing in international stocks or funds allows you to tap into growth outside your home country. For example, emerging markets in Asia or Latin America may experience faster growth than developed markets like the United States or Europe. At the same time, diversifying geographically can protect you from country-specific risks. If the United States market is in a downturn, international stocks may hold up better, providing stability for your overall portfolio. Global funds, international ETFs, or country-specific ETFs are great ways to gain exposure to foreign markets without the complexity of buying stocks in individual countries. Now let's talk about how to balance your portfolio. One of the most important aspects of diversification is finding the right balance between risk and reward. Your ideal allocation depends on your investment goals, time horizon, and risk tolerance. For example, if you're young and have a long time horizon, you might want to take more risk with a higher percentage of stocks in your portfolio. But if you're closer to retirement, you may want to reduce your exposure to volatile stocks and shift more into bonds and other income-generating assets. A typical allocation might look something like 80% stocks and 20% bonds for younger risk-tolerant investors, 60% stocks and 40% bonds for investors with a moderate risk tolerance, and 40% stocks and 60% bonds for those nearing retirement or looking for less risk. The key is to adjust your allocation as you age and as your financial situation changes. Regularly rebalancing your portfolio, reviewing and adjusting your allocations, ensures that your investments stay aligned with your goals. Over time, some assets in your portfolio will outperform others, causing your asset allocation to shift. This is where rebalancing comes in. Rebalancing involves periodically reviewing your portfolio and adjusting it back to your original target allocation. For example, if stocks have been performing well, they may now make up 90% of your portfolio instead of 80%. To rebalance, you would sell some of your stocks and reinvest that money into other areas like bonds to restore your intended balance. Rebalancing doesn't have to be done frequently. Usually once or twice a year is enough. But it's important to keep your portfolio aligned with your risk tolerance and financial goals. So that's how you build a diversified portfolio. To recap, diversify across different asset classes: stocks, bonds, real estate, commodities, and cash. Diversify within the stock market, spread your investments across different sectors and industries. Geographic diversification. Don't just invest in your home country, consider global markets for better growth potential. Balance your portfolio. Find the right mix of risk and reward that suits your age, goals, and risk tolerance. Rebalance regularly. Make sure your portfolio stays aligned with your goals and risk preferences. A well-diversified portfolio helps you reduce risk, maximize returns, and stay prepared for various market conditions. Thanks for watching Wealth and Wisdom. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss an update. In the next video, we'll discuss the importance of long-term investing and why patience really does pay off in the world of investing. Leave any questions or comments below. I'd love to hear from you. Until next time, stay wise, stay patient, and keep investing.